Stop. Stop looking at the stock tickers. Stop listening to the talking heads on cable news debating interest rate basis points. Put down the technical charts. The most critical financial signal on planet Earth right now is not happening on Wall Street. It is not happening in the city of London. It is happening in the aisles of a discount warehouse club in suburban America. When the average soccer mom, someone whose previous investment experience was limited to a target date 401k fund, is literally fighting to secure gold bars at a grocery store alongside bulk toilet paper and rotisserie chickens, the game has fundamentally changed. The public is waking up, and the physical inventory is gone. Welcome back. We spend a lot of time on this channel dissecting complex macroeconomics, analyzing derivatives markets, and looking at geopolitical energy flows. We look for the signals that the mainstream ignores. But sometimes the most powerful signal is the one that is so obvious, so pervasive, that the smart money completely dismisses it as noise. Today we are engaging in a deep dive investigation into a phenomenon that financial historians will look back on as the tipping point. We are talking about the Costco gold rush. This is not a gimmick. This is not a blip. This is a structural shift in consumer psychology that signals the beginning of the end for blind faith in fiat currency. For months now, major retailers, Costco being the most prominent, but also Walmart and others quietly testing the waters, have opened the floodgates. They started selling precious metals directly to the retail public. We are not talking about overpriced commemorative coins sold on 3 a.m. infomercials. We are talking about investment-grade bullion, 1-ounce Pamp Suisse gold bars and assay cards, tubes of 20 silver eagles, serious metal for serious wealth preservation. And what happens? Every single time they list this inventory online, it does not just sell. It evaporates. We have been tracking these drops closely. They are gone in hours. Sometimes they are gone in minutes. There are verified reports of recent drops on Costco's website where millions of dollars of physical silver and gold were siphoned out of the retailer's inventory in under 4 minutes. 4 minutes to move massive quantities of strategic physical assets into the hands of retail buyers. Why is this so critical? Why should sophisticated investors care what happens at a discount warehouse club? Because this is the ultimate sentiment indicator. This is the Normie indicator. Think about the previous precious metals bull markets. They were driven by specific demographics. The die-hard gold bugs, the doom preppers, the contrarian hedge fund managers. The smart money bought their gold 5 years ago. They are already positioned. The people crashing the Costco website at 2 a.m. to buy a gold bar are not gold bugs. They are everyday people. They are middle-class families, retirees, teachers, plumbers, and office workers. They are the demographic that has traditionally trusted the system implicitly. They put their money in a savings account, they trusted their financial advisor, and they believed the central bank had everything under control. That trust is shattered. The Costco phenomenon is visceral proof that the average citizen, even if they cannot articulate the mechanics of quantitative easing or yield curve control, understands deep in their bones that something is profoundly broken with their money. They feel it every time they fill their gas tank. They see it in their shrinking grocery carts. The official government inflation print might say one thing, but their wallet tells them a different, much more painful truth. They realize their labor is being devalued by the hour. When these people take the extraordinary step of removing thousands of dollars from the banking system, money that was safe and insured, to buy a physical bar of yellow metal that pays no interest, is heavy, and is hard to store, it signifies a massive psychological break. It is a vote of no confidence in the purchasing power of the currency. We must understand the psychology of this stampede. Why Costco? Because Costco is trusted. It is where middle America goes for value, for safety, for predictability. Buying gold from a specialized bullion dealer on a sketchy-looking website feels intimidating to the average person. It feels niche. It feels risky. But buying gold from the same place you buy your 50-pound bag of rice and your vitamins, that normalizes the transaction. It removes the friction. It lowers the barrier to entry for what is essentially panic buying. It makes the act of fleeing the currency feel like just another grocery run. And make no mistake, this is panic buying. We monitor the forums, the Reddit threads, the social media groups dedicated to these retail drops. The atmosphere is frantic. It is desperate. People are setting alarms for the middle of the night, hoping to catch a restock. They have their credit card information preloaded, fingers hovering over the refresh button. When they manage to secure a bar, the relief they express is palpable. When they miss out, the anger and anxiety are intense. This behavior mirrors exactly what we see during supply chain crises for essential goods. Remember 2020? Remember the fights over toilet paper? What we are witnessing now is the financial equivalent of that. People are realizing that financial security is scarce, the window is closing, and they are stampeding to secure what they believe is the only real safe haven left available to them. They are trading paper promises, dollars that they know are being printed into oblivion for physical reality. They don't want a gold ETF that tracks the price. They don't want a mining stock. They want something dense they can hold in their hand and hide in their safe. Mainstream financial analysts have tried to dismiss this. They call it a gimmick. They say it's a negligible part of the overall global gold market, a rounding error. They are tragically, dangerously underestimating what is happening. They are looking at the present numbers and ignoring the trajectory. While exact figures are closely held corporate secrets, credible analysis from major bank trading desks suggests Costco alone is selling anywhere from 100 million to 200 million worth of gold per month. That is just one retailer. That is just the beginning. That is not a gimmick. That is a massive new demand channel opening up almost overnight, creating a suction vortex for physical product. And here's the crucial part. It is a demand channel that is completely price insensitive. When a hedge fund buys gold, they are looking at technical levels, Fibonacci retracements, support, and resistance. They might wait for a dip to enter. They are trading. The Costco buyer does not care about the spot price. They don't care if gold is at an all-time high. In fact, the higher the price goes, the more desperate they become to buy it, because the rising price confirms their fear that their dollars are collapsing. They are buying for insurance, not for speculation. And when you are buying fire insurance, because you smell smoke in your living room, you don't haggle over the premium. You buy it at any price. Notice the deafening silence from the major financial networks on the implications of this. They might mention it as a quirky human interest story at the end of a segment, chuckle about people buying gold bars with their groceries, and move on to discussing Nvidia earnings. They do not want to discuss the implications, because if they acknowledged what this trend really means, they would have to acknowledge the systemic rot that is driving it. They would have to admit that the average citizen is losing faith in the currency that underpins the entire financial superstructure that employs them. The media wants you focused on the stock market. They want you focused on nominal highs in equities, which are largely being inflated by currency debasement anyway. They do not want you looking at the exit doors. And physical precious metals are the ultimate exit door from the traditional banking and financial system. We are witnessing a profound behavioral shift from consumption to preservation. For decades, the Western consumer, particularly the American consumer, has been conditioned to spend. The entire economy is built on the idea that you earn dollars and immediately exchange them for goods and services because saving dollars is a losing proposition due to constant inflation. The Costco gold buyer is breaking that cycle. They are taking liquidity out of the velocity of money and freezing it into a long-term inactive asset. Instead of buying a new flat-screen TV or a slightly better car, depreciating consumer goods, they are buying money that cannot be printed. This is a return to a Depression-era mentality emerging in a time of ostensible economic growth. Why? Because the public knows, deep down, that the growth is artificial, built on debt and printing, and that the bill is finally coming due. Finally, consider the virality of this phenomenon. When a hedge fund buys gold, they bury it in a vault in Switzerland and tell no one. When a suburban dad buys a gold bar at Costco, he shows everyone. There's a tangible visceral reaction when someone holds a solid ounce of gold or a heavy tube of silver for the first time. It feels dense. It feels real in a way that a bank account balance on a screen never can. That experience is contagious, he tells his friends. He posts a picture on Instagram. He shows his neighbor at the barbecue. Look at this. Real money. Costco is marketing sound money to the masses in a way no bullion dealer ever could. It is demystifying gold ownership. It's making it accessible, socially acceptable, and urgently desirable. Every time a drop sells out in 4 minutes, it sends a demand shockwave through the system. It signals to thousands of other people that they missed out again, increasing the desperation for the next drop. It creates a self-perpetuating cycle of FOMO, fear of missing out, centered not on a meme stock, but on the oldest form of money in human history. The retail public is awake. The sleeping giant of mainstream demand has been roused by inflation. They are hungry for physical metal, and they are cleaning out the inventory at an alarming rate. But the empty digital shelves at Costco are just the symptom. Next, we are going to go behind the scenes. We will look at the supply chain that is buckling under this new pressure. We will expose the mechanism of shortage and explain why the paper price you see on TV is becoming increasingly disconnected from the reality of getting your hands on actual metal. The squeeze is just beginning. Welcome back. We have established that the public is panic buying precious metals through mainstream channels like Costco, clearing out tens of millions of dollars of inventory in mere minutes. This is a massive, undeniable sentiment indicator that trust in fiat currency is eroding among everyday people. But the crucial question you must ask is, why does it sell out so fast? Why can't Costco, a company famous for its massive, efficient supply chain logistics, simply order more? If the demand is there, why isn't the supply meeting it? The answer lies in the terrifying fragility of the physical precious metals supply chain. The empty, Add to cart button on Costco's website is merely the visible symptom of a much deeper systemic shortage that the paper markets are desperately trying to hide. We need to look at the plumbing of the gold market to understand why the water pressure is dropping. The modern global economy is built on just-in-time inventory management. Retailers, wholesalers, and manufacturers hold as little stock as possible to reduce costs, relying on smooth, uninterrupted supply chains to deliver goods exactly when needed. This system works beautifully for sneakers, televisions, or cereal. It fails catastrophically when applied to a finite strategic asset like gold or silver during a time of monetary crisis. The supply chain for retail bullion is incredibly narrow. When Costco wants to sell 10,000 gold bars, they don't call up a gold mine in Nevada or South Africa. They call a major wholesale distributor or a sovereign mint. These wholesalers operate on thin margins and limited physical inventories. They are built for a steady, predictable trickle of demand from coin shops and niche investors. They are absolutely not built for a sudden, violent tidal wave of demand from the general public. When Costco releases a drop, it's like turning a fire hose into a garden hose. The pressure is too high. The pipe cannot handle the volume. The wholesalers get cleaned out instantly. They then have to turn around and try to source metal from refineries and mints, who are already backlogged and facing their own constraints. Let's dig deeper into the mints. Whether it's the US Mint, the Royal Canadian Mint, or private giants like Pamp Suisse, whose bars Costco sells, they all have physical limitations. You cannot just print more gold bars with the press of a button like a central bank prints dollars. Mints are factories. They are industrial operations. They have a finite number of presses, a finite amount of skilled labor, and strict quality control standards. They require raw coin blanks or refined bullion to operate. We are seeing unprecedented strain on these facilities. The U.S. Mint has repeatedly had to ration sales of silver eagles to its authorized purchasers because they simply cannot stamp them fast enough to keep up with demand. They run out of silver blanks. Machines break down due to overuse. They cannot add shifts fast enough. When retail demand spikes by 300% or 400% overnight because the mainstream public decides they need gold, the mints cannot just ramp up production by 400% tomorrow. It takes months or years to build new capacity, order new machinery, and train new staff. This is a hard physical bottleneck that no amount of paper money can solve immediately. The demand is exponential. The supply response is linear and slow. And this bottleneck is where the squeeze happens. This physical bottleneck leads to one of the most important concepts you must understand: the disconnect between the spot price and the physical price. The spot price you see on Bloomberg or CNBC is largely determined by the trading of paper futures contracts on the COMEX in New York or the LBMA in London. These are financial bets on the direction of gold price, often leveraged 10 to 1 or more. Very little physical metal actually changes hands in these markets. It's a casino of paper promises. The physical price is what you actually pay to hold the metal in your hand. It is the spot price plus a premium. When physical inventory gets tight, premiums explode. We are seeing this right now, particularly in silver, but increasingly in gold. The spot price of silver might be $30, but if you want to buy a silver eagle from a dealer, if they even have them in stock, you might have to pay $40 or $45. That massive premium is the real market screaming that physical metal is scarce. It is the market saying, I have plenty of paper contracts at $30, but if you want the actual metal, it's going to cost you pain. Costco is able to offer relatively low premiums because of their massive buying power and membership model, which is exactly why their inventory evaporates so instantly. They are essentially offering physical gold at a discount to the actual street price. They are an arbitrage opportunity that the market devours in seconds. The speed of the sellout is a measurement of how underpriced physical metal is relative to the paper market. We speak with contacts in the wholesale bullion market. The stories they tell are consistent. The velocity of metal moving out the door is unlike anything they have seen since the depths of the 2008 financial crisis or the panic of the 2020 lockdowns. But this time, it feels different. It's not just a spike driven by a singular event. It's a sustained drain driven by a shift in psychology. Major dealers are having trouble restocking key items, and crucially, they're seeing very little secondary market supply. In normal times, when the price of gold rises, many people sell their old jewelry or coins back to dealers to take a profit in dollars. That supply flows back into the market and cools things down. Right now, nobody is selling. The public is buying, and they are holding. The flow of metal is one way, out of the vaults and into private hands. The secondary market has dried up because people are terrified of holding cash. Why would you trade an appreciating safe asset for a depreciating risky currency unless you absolutely had to pay an emergency bill? The hoarding has begun. We must also look deeper into the supply chain, right down to the mines. The reality that paper traders ignore is that gold and silver are geologically finite assets. Global gold production has effectively plateaued. We are not discovering massive new deposits. Miners are having to dig deeper, use more energy, and process lower grade ore just to maintain current production levels. It takes 10 to 15 years to bring a new mine from discovery to production, facing immense regulatory hurdles, environmental opposition, and massive capital costs along the way. You cannot just flip a switch and supply the world with more gold because Costco shoppers want it. The geological reality is a hard constraint. Silver is even more precarious. More than half of all silver demand is industrial, for solar panels, electronics, electric vehicles, batteries. That demand is inelastic. Manufacturers must have it regardless of price to build their products. As the green energy transition accelerates, industrial demand is soaring. The retail buyer at Costco is competing for physical silver bars against giant industrial conglomerates who need the metal to keep their factories running. Who do you think is going to win that fight for supply? For decades, the immense volume of paper trading has suppressed the true price discovery of physical precious metals. The ability of bullion banks to sell unlimited amounts of paper gold into the futures market has absorbed demand that would otherwise have sent physical prices into the stratosphere. But this entire mechanism relies on confidence. It relies on the vast majority of market participants being happy with a paper contract or an ETF share and never demanding delivery of the actual metal. The Costco phenomenon signals that this confidence is breaking down at the foundation of society. The average person doesn't want paper. They don't trust promises. They don't trust the banks to hold it for them. They want delivery. When enough people demand physical delivery, the leverage in the paper market turns from a tool of suppression into a massive liability. It creates the potential for a short squeeze of historic proportions. If everyone who thinks they own gold via paper contracts tried to take possession of it tomorrow, there isn't enough gold in the commercial vaults to satisfy a fraction of the claims. The panic buying at retail level is the tremor before the earthquake. It is the signal that the physical market is reasserting its dominance over the paper market. The supply chain is maxed out. The mints are overwhelmed. The wholesalers are drained. Next, we will connect these supply and demand dynamics to the macro endgame. We will look at why trust in fiat is eroding so quickly right now, the historical inevitability of what we are witnessing, and what it means for your financial future when the inventory finally runs out completely. Welcome to the conclusion of our investigation into the Costco gold rush. First, we expose the massive sentiment shift as everyday consumers panic buy bullion at grocery stores, signaling a mainstream awakening. Then, we detail the fragile, bottlenecked supply chain that cannot keep up with this surge in physical demand, revealing the disconnect between paper prices and physical reality. Now, we must step back and look at the why. This isn't just about a hot new product at Costco. This behavior is a symptom of much larger systemic disease, the terminal erosion of trust in fiat currency. The retail panic buying is the rational response of a population realizing, perhaps subconsciously, that their money is broken. We are watching the endgame of a decades-long monetary experiment, and the average citizen is rushing for the lifeboats. The primary driver of this rush into gold is the undeniable reality of inflation. It is the silent thief that robs you while you sleep. For years, central bankers told the public that inflation was dead. Then, when it arrived with a vengeance post-2020, they told us it was transitory. The public now knows this was false. They feel the cumulative effect of years of massive currency creation every time they pay their bills, buy groceries, or pay rent. They realize that the dollars they worked hard for are leaking purchasing power by the day. They are running on a financial treadmill just to stay in place. Financial history teaches us a simple lesson. Governments facing massive debts fundamentally have only two choices. They can default on the debt honestly, which causes immediate catastrophic deflationary collapse, or they can inflate the debt away by devaluing the currency, paying back bondholders with cheaper money. Throughout history, they almost always choose inflation. It is the politically easier path. It is the path of least resistance. The average citizen feels this happening. They feel their standard of living slipping away. Buying a gold bar at Costco is an act of financial self-defense. It is an attempt to opt out of the inflationary system and store the product of their labor in something that cannot be debased by policy or printed at whim by a committee. What we are witnessing in the Costco aisles is a textbook example of an economic principle known as Gresham's Law. It is often summarized as bad money drives out good. When an economy has two forms of money in circulation, and one is artificially overvalued by decree, fiat currency, which is being debased, while the other is intrinsically valuable, gold, silver, human nature takes over. People will spend the bad money as fast as possible to get rid of it before it loses more value. Simultaneously, they will hoard the good money and refuse to spend it. They get paid in depreciating dollars. The bad money? They immediately rush to Costco to exchange those dollars for gold bars, the good money. They then squirrel that gold away and refuse to spend it because they know it will buy more goods in the future, while the dollars in their pocket will buy less. The velocity of bad money increases. fueling further inflation, while the good money disappears from circulation into private vaults. The empty shelves at Costco are Gresham's Law playing out in real time on a massive scale. The public is dumping paper and grabbing metal. If you think the Normies buying gold at Costco are just paranoid tinfoil hat wearers, or that this is just a retail fad, you need to look at who else is doing the exact same thing at a much larger scale: the central banks themselves. Over the last few years, global central banks have been buying gold at a record pace, levels not seen in over 50 years. China, Russia, India, Poland, Singapore, nations across the Middle East, sovereign entities around the world are aggressively, frantically adding tons of physical gold to their national reserves. They are repatriating gold held abroad back to their own vaults. Why? For the exact same reason the suburban shopper is buying an ounce at Costco. They are seeking to diversify away from fiat currency risks. They are de-dollarizing. They recognize that in a world of massive sovereign debt and geopolitical weaponization of finance, gold is the only neutral counterparty-free reserve asset. When the very entities responsible for managing the fiat monetary system are frantically buying the alternative to that system, it is the ultimate validation of the retail buyer's thesis. The central banks know the game is changing. They are preparing for a new monetary order. The Costco shopper is just following the lead of the biggest money on the planet. We are living through a period where the illusion of wealth is colliding with the reality of real wealth. We have inflated stock market valuations and real estate bubbles, fueled by years of cheap credit and liquidity injections. This is paper wealth. It is brittle. It depends on confidence, functioning electronic systems, complex legal structures, and the solvency of counterparties. It can vanish in a flash crash. It can be frozen by an institution or a government with a keystroke. Physical gold in your possession is autonomous wealth. It has no counterparty risk. It is not someone else's liability. It doesn't rely on the power grid or the internet. It has been recognized as a store of value for 5,000 years across every culture on Earth. The Costco phenomenon shows a return to tangibility. People are intuitively grasping that when the system shakes, you want to own things that are real. You want assets you can thump on the table. You want wealth that exists outside the digital banking ledger. This leads us to the inevitable conclusion. The window of opportunity to acquire physical precious metals at current paper prices is rapidly closing. Right now, you have a unique situation where the paper price is still relatively suppressed by futures trading, while physical demand is exploding. This anomaly cannot last forever. Something has to break. We are already seeing signs of the physical market breaking away. The high premiums we discussed were the first stage of this decoupling. The next stage is simple unavailability. We are already seeing it in the 4-minute sellouts. We are seeing it in dealer delays. Soon, it won't just be a wait. It will be out of stock indefinitely for the retail buyer. The remaining inventory will be reserved for larger industrial and institutional players who have securing supply lines. When the general public fully realizes that the lifeboat is full, that they cannot just log onto Costco and trade their shrinking dollars for gold, the panic will intensify exponentially. This fear of missing out will turn into a fear of being trapped in paper. The stories about Costco selling out of gold are not cute anecdotes for the business section. They are flashing red warning sirens about the fundamental health of the financial system. The Normies have entered the chat. They are bringing billions of dollars of new, sticky demand into a constrained, finite physical market. They are draining the supply chain faster than it can be replenished. They are signaling a complete, irreversible loss of faith in the purchasing power of the currency. Do not look down on the people panic buying at the grocery store. They are ahead of the curve. They understand the reality on the ground better than the economists in their ivory towers who look at flawed models. The inventory is disappearing. The premiums are rising. The supply chain is cracking. The squeeze is on. The question is no longer, should I own precious metals? The question is quickly becoming, can I still get them? History shows that when the public rushes into real assets, the fiat currency enters its final volatile phase of decline. The game has changed. The inventory is gone. Ensure you are positioned accordingly before the window closes completely.